Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you this morning, and as always, if you have any financial questions, investment questions, retirement questions, send those to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. We have a number of free reports you can download, educate yourself. If you're a pre-retiree, if you're a retiree, you have $1 million portfolio and greater, these reports are a must-read. Our number one downloaded report as we go into 2024 is the 3 biggest risks you must avoid for 2024. It's a must-read for any investor who at all has any questions about their portfolio, the economy. Maybe you're a little nervous on the advice you're receiving from your current advisor. The 3 biggest risks you must avoid now is a must-read if you care about your money, a potential collapse in 2024, and how ultimately to protect your money. You know, a couple of things that I want to discuss today, and we're getting a lot of questions on this, and there's a lot of talk in the media about the bond bubble is ready to burst. You know, one of the things I discussed 4 or 5 years ago is investors should be in short duration or floating rate type bonds in general. That was 4 or 5 years ago. We had, in the last year and a half, as you know, the Fed has raised rates substantially. So rates went basically from pretty much zero, and now you're looking at 5-year treasuries on the 10-year. And ultimately, do we see rates going much higher than they are today? Absolutely not. So we're not seeing a bond bubble burst, meaning bond values are going to drop substantially. You saw that in 2022. Those of you who owned longer duration bonds, whether it's treasuries or corporate bonds, that were probably more than 5, 10, 15, 30 years in duration, you lost a lot of money on your bond portfolio in 2022. 2023 has not been a lot better than 2022. Most bonds are down even again this year. So 2 years in a row, bonds were really cremated. And investors who didn't heed our warning 4 or 5 years ago, you lost probably between 30 to 50%, depending what kind of bonds you own in your portfolio. If you switch to short-term duration bonds, when we discussed that many years ago, or floating rate type bonds, these are very short-term duration, you probably actually may have made a few dollars in your bond portfolio instead of losing 30, maybe 50%, again, depending what kind of bonds you own the last 2 years. We're seeing a reverse for this going forward. As we get into 2024, ultimately we see the Fed going to start reducing interest rates. So remember, when rates go up, bond values go down. It's a teeter-totter effect. So if the Fed starts reducing rates, bond values should start moving up. So we're at the point in time where we firmly believe investors should start looking at making some changes to their bond portfolio and going more towards that 10-year maturity, maybe up to a 20-year type maturity level, whether it's treasuries or corporate bonds. Because what you're looking for is called total return. Gain of the value of that bond as rates come down, and the interest rate you receive, which will ultimately, be higher than short-term duration bonds at this point. The other point that I want to talk about today, and again, a lot of questions that have come in on this in the last, say, 30 to 60 days, is guaranteed retirement income. Let's talk about what's going to ruin your retirement. What's going to ruin your retirement is guaranteed retirement income. These are often pushed by annuity salespeople and insurance companies. Everybody likes a guarantee, but you have to understand what guaranteed retirement really is. Guaranteed retirement income is basically whether they take your money in an annuity, annuitize it at a substandard table, and it often takes 18 to 20 years of an income stream to get your own money back. Is that a guarantee? Absolutely not. You got your own money back over 18, 20 years on a payout from an annuity. No rise of income, no way to combat inflation's problems and devastating impact. Again, annuities in general are not good investments for you, the investor. But investors are often sold annuities because they hear the word guaranteed. And if I guarantee you get your own money back and not a return on your money, think about how devastating that is to your retirement. as inflation keeps going higher each year, but your actual spendable income actually is going down after inflation and taxes. It's not a good place to be. So when you hear the word guaranteed retirement income, are there better ways to position your portfolio where you can have income that can potentially rise, have growth of that portfolio? There certainly are better methods, in our opinion, than ever buying an annuity. If you want to learn why annuities are dangerous to your wealth and retirement, go to ReznyWealth.com, click on the Special Reports tab, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It'll discuss why guaranteed income is not what it pans out to be. It'll talk about inflation. It'll talk about realistic returns that you'll get on these annuities and why locking your money up with big surrender charges and extra taxes is never a good way to go for a retiree. Go to ReznyWealth.com. You can download that report for free or any of our groundbreaking reports. Learn, educate yourself so you can make better financial decisions, because ultimately, if you want to secure retirement, you get it from understanding what to do with your money and, more importantly, what bad investments you need to avoid. All of our reports cover those topics, and you'll get the education ultimately you need. Peter in Punta Gorda, Florida. I own 30% of my portfolio in high-yield bond ETFs for higher income with safety. Your thoughts? First off, Peter, high-yield bonds are risky bonds. Whether it's individual high-yield bonds, these used to be called junk bonds, by the way, or if it's in an ETF format or a mutual fund format. High-yield bonds have a lot of volatility. If you look at statistical numbers, high-yield bonds have about as much risk and volatility as the S&P 500. The S&P 500 is a broad market basket of weighted securities, investment equities. So think about this. If you have the same volatility as the stock market, as the S&P 500, but you've made significantly less money over the last 5 and 10 years owning high-yield bonds, why would somebody want to own high-yield bonds? I do not like high-yield bonds in this environment. I think if you're taking the kind of risk high-yield bonds offer, what I would ultimately do is look for total return out of the S&P 500, where you can have growth potential, income from the dividend potential, and the combination of that gives you ultimately total return. That is a much better play, in my opinion, than owning any high-yield bonds. And I certainly would not own 30% of my portfolio in high-yield bonds. It's a risky venture. What you will find is your investment returns the last 1, 3, and 5 years have been subpar with other investments that are out there in the marketplace. Suzanne in Naples, Florida. NextEra Energy stock, what do you think? Great question. Ultimately, I think this is a decent stock, but not a stock that we would own in this juncture. One of the things that I think investors need to look at is, where is the energy market ultimately headed? And I think what we're going to see with energy prices and oil prices in general is ultimately higher if we stay with the current regime, the current presidency and policies that the Biden administration is pushing out. If we stay in that role, I see energy prices going higher because of supply and demand issues. You've got Saudi Arabia raising prices and curtailing production. You've got the same thing happening in Russia. That is coming against the U.S. marketplace. So ultimately, what I would look at if I'm looking at oil and gas, I would look at the XLE. Fair disclosure, we own positions in that currently and have for a couple of years, and XLE has done quite well. Not a guarantee of the future, but I want to be in an area that ultimately is going to benefit the most from energy prices going higher, oil and gas, which we see for at least the next 3 to 6 months. And again, if the Biden administration changes their tune, then maybe we'll change our tune at that point in time. Brad, Iron Mountain. I work for a company that owns most of my have most of my portfolio in this stock. Brad, I would not do that. So think about this. If you work for Iron Mountain, you work for the company. Your salary, your benefits, your life savings essentially is tied to this company. and then you own most of your investments in that company stock, that is a horrific thing to do. Iron Mountain hasn't done that great long term, and ultimately I think owning most of your money in any one stock is a huge mistake, no matter how well you think you own the stock. I would immediately trim your exposure. Never own more than 3 to 5% of any one individual stock. You need to protect your not only your job, but also your portfolio. Don't have both tied together. It's a risky venture. I'm going to take a quick break. I'm going to take more questions after this, but make sure you go to ReznyWealth.com, download any of our groundbreaking reports, the 3 biggest risks you must avoid for 2024. If you care about the future collapse of the equity market in the U.S., what about overseas? Are you getting real advice? Learn about what you should and should not do with your money. The 3 biggest risks you must avoid now report is only available at ReznyWealth.com. Download it for free. Educate and protect your money. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report. The 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program. As always, go to ReznyWealth.com. You can sign up for a consultation there. As many of you know, Rezny Wealth Management is a fee-only fiduciary money management firm. We do manage larger portfolios of $1 million and greater. So if your portfolio is at least $1 million and you are looking for professional management because the advice you're currently getting just doesn't seem right, doesn't seem like it's working, and you want to talk to us about managing your money properly and effectively, call our firm during the week or go to ReznyWealth.com and click on that consultation tab. You know, one of the things that I think a lot of investors are questioning is the stock market right now. What do you think about the stock market now at new highs? Wall Street got it wrong again, I'm hearing from a lot of people. Are there more gains ahead? Let's talk just a little bit about that. Yes, there's parts of the U.S. equity market that are at all-time highs. The U.S. market has done quite well year to date. Not all parts of the U.S. stock market, but a lot of parts of the stock market have done quite well. Wall Street, yes, got it wrong all of 2023. If you remember back in the beginning of this year, Wall Street, we're going to have this huge recession. Stock market's going to collapse 20-30%. Wall Street was wrong again. These big banks and Wall Street style firms basically make a lot of money when you make a lot of changes to your portfolio. Whatever Wall Street tells you to do, our recommendation is probably do the opposite. Because again, day late and a dollar short is Wall Street and banks. What do I see going forward? Our big concern is 2024. As the economy continues to show slowdowns, not only in the housing market, but job starts, things that are negatively going to impact the U.S. economy, we're getting concerned. We're going to be making portfolio adjustments for our clients as necessary. I think the day of investors blindly standing by and having that asset allocation pushed by Wall Street or that buy and hold portfolio is going to be devastating in 2024. I think investors need to make appropriate changes to their portfolio when necessary and not sit idly by as risks are starting to bubble up in certain parts of the U.S. equity market and certainly around the world. Question for you. How did your portfolio perform this year? Is the advice you are receiving, is it actually working? What we're finding is this. A lot of the new clients that are hiring Rezny Wealth Management in 2023, they're coming from these big Wall Street style firms and banks. Most of the people weren't happy with the results this year or even in the last 5 years. But finally they got fed up with bad advice and they seek out a difference. One of the things I always want to stress to every investor is if your portfolio performance seems like it's kind of lackluster, if you're having more volatility than the market is and you're making less money, that should be a cause for concern. If the calls that the firm you're working with seem like they're always off and you're at the wrong side of the market whether it's bond market or stock market, and again, your portfolio is not performing well, the negative impact of that over the next 3 to 5 years is going to be devastating. Make sure that your portfolio, the risk you're taking, is performing in line with the risk of the indices that you're tracking. If it's not, seek out different advice. As I've always suggested to every one of our TV and radio show listeners, the only kind of firm you should ever work with is a fee-only fiduciary money management firm that is active, that can make appropriate changes when necessary, as changes in the economy, which we're starting to see elevate on the negative side, need to be made. Ted in Fort Myers, Florida. I have managed my own investments for the last 10 years. Growth is my objective. My returns have been about 7% on average for 10 years. Your thoughts on turning over management to a professional? What do I give up? Ted, great question. So over the last 10 years, if you look at the S&P 500, it's averaged close to 11% a year. You've made 7. That's a lot less. You're a growth style portfolio. Growth style portfolios, realistically, our rule of thumb is you should be shooting for 10% returns. But you've made significantly less than that the last 10 years. Maybe managing your own money isn't the way to go. Maybe the best thing to do is find a real money management firm that manages your money professionally, that is running a strategy, does the research, can make the appropriate changes when necessary. What do you give up? You give up a lot of headaches for yourself. You're giving up day-to-day responsibility and having to manage your own money 8 hours a day and doing a lot of research daily. Managing your own portfolio takes a lot of work. If you spend the time, if you spend money on research, you can ultimately do well. But if you don't spend the time and money on research, just buying a bunch of different stocks or bonds and watching a news program probably isn't going to help you a lot, because you don't have a strategy and you're not following a strategy. And often the decisions a lot of do-it-yourself investors make, I hate to say, is based on gut reaction or emotion, which again usually is the wrong side of the fence. So what I would say is you can go to ReznyWealth.com, check out our consultation tab. We'd love to help you. I think what you're going to give up is a lot of anxiety and a lot of misery doing it yourself. And what you're going to ultimately gain by hiring a real firm to manage your money, I think, is ultimately calm, ease, and really some peace of mind knowing that somebody else is doing the heavy lifting. We'd love to talk to you, though, if your portfolio is in that $1 million range and greater. Frederic in Florida. Cheap dividend stocks to invest in as a retirement income opportunity. Great question. So don't look at cheap stocks. Don't look at just dividend stocks. Don't look at growth stocks. You really want to look at the gamut of investments, whether it's bond, real estate, equity stocks. You want to look at them all. And you're looking them at the context of where is the economy and where's the cycles for these different investments. So what you're trying to do is you're trying to pick the best investments based upon current economic time and the cycles we're in. You build a portfolio, and then over time, as you continue to monitor the economy and these trends, you slowly make adjustments to that portfolio as times change. Best example I could really give today is interest rates are up. We see rates are going down, so we're making adjustments to client portfolios where we're going more on the longer term duration on bonds versus the short term floating rate type interest rate we had in our portfolios the last 2 or 3 years. So times change, and you're not making drastic changes daily, but as those economic scenarios change, you need to change how you're invested or investments within that portfolio. Fred in Naples, Florida. Gold as an investment. I'm scared of the government taking our money and the dollar not being worth anything. Fred, I've been managing money over 30 years. I will tell you, from the day I started managing money when I was 20 years old, I've heard thousands of people calling that the government's going to take their money, the dollar's not going to be worth anything, it's not going to be the currency of choice, the world's coming to an end, for over 30 years. And it hasn't happened. And it's probably not going to happen in the next 30 years. Gold as an investment, there's times that we own gold. We don't own it currently. There's times gold makes sense in a portfolio for a positioning. We currently don't own gold again, and I don't see buying gold anytime soon. But don't buy gold because of crazy commercials about the world's coming to an end. I think that's ultimately a huge mistake, and I think of a lot of investors, again, the emotions bubble up. The government's not going to come take your money. If the world comes to an end, it doesn't matter if you own gold or not because the world came to an end. I hate to say that. So buy gold when it's appropriate. Currently, it's not appropriate. There's other better investment options, we feel, but a great question. I'm going to take a quick break. Go to ReznyWealth.com. Make sure you download our groundbreaking report, The 3 Biggest Risks You Must Avoid Now for 2024. If you care about the upcoming recession, the imminent market collapse, not here, but maybe around the world, like my last question about gold, what should you be doing now with your money, and who do you entrust with your money? The report is free. The information is invaluable. It's a must-read for any investor who's got $1 million portfolio and greater, who cares about their retirement security, and ultimately cares about keeping control of their wealth. Go to ReznyWealth.com, click on that special reports tab, download the report. Great read, great education. I'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, The 3 Biggest Risks You Must Avoid Now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're joining today's program, and we're getting a lot of questions in. Send those to Brian Rezny at ReznyWealth.com. You know, a lot of you, the questions I get, by the way, often are very similar, meaning other people that listen to our TV and radio shows have very similar questions. So any question you have, send it in, because people often won't send questions in because they're kind of nervous to get their question answered. The best way to get ahead in life, in our opinion, financially, is get your question answered and know that you're doing the right things with your money, or maybe learning there's a better option. Richard in Cape Coral, Florida. I bought Disney stock 7 years ago as a good, solid company for income and growth. I've lost a lot, and is it time to sell? Richard, I would say Disney as a company, good company, I think it's a good company. Is it a good investment? No. Even though it's dropped a lot, their PE ratio is still very high. What I would say is this. I would sell Disney, take your tax loss, and move on to greener pastures. You can keep watching Disney after you sell it. And if at some point they really change their business model where they start to grow again, I think maybe it's an opportunity as a value stock. But we don't own it currently. We're not looking at owning it. I think there's much better places to put your money. Disney simply is not it. Richard, realty income shares have plummeted. Buy, hold, or sell? Excellent question, Richard. So realty income is really, they own commercial property around the country. And one of the things that I will say in general, this is a traded REIT, which is much different than a non-traded REIT that's often sold by the Wall Street brokerage style firms. So traded REITs have opportunity. They don't all have opportunity. And just because something drops a lot doesn't mean it's a compelling buy. The problem in the real estate area within this country and actually other parts of the world is really things are changing in real estate. So depending what kind of real estate portfolio they own. Big malls as an example, they're going by the wayside. Malls are closing all the time. People don't go to malls as much. So if you own a REIT that owns a lot of malls and those malls are closing or occupancy is going down, your cash flow is going down, the value of the real estate's going down. I think real estate at this point in time, I would avoid traded REITs in the U.S. at this time. I think we've got at least 2 years, maybe 3 till the bottom comes in. A lot of these REITs are going to continue to go down. A lot of the occupancy is going to get negative. And I think ultimately the cash flow is going to go down, which is going to drive down share price. Stay away from REITs for the next 2 to 3 years. The other recipient of this is going to be a problem is ultimately going to be the banks. So these small regional banks that finance a lot of these REITs are going to have problems in addition. So 2 areas that we really are avoiding right now is traded REITs and small to regional banks because they have a lot of risk exposure to commercial real estate, which basically ties into your question. Great question, though. Jesse from Cape Coral, Florida. How much risk is safe for a retiree to take with their investments? Excellent question. Ultimately, all risk is volatility, your portfolio going up and down. I'll give you an example. If you have $1 million portfolio and your portfolio goes up and down, how much volatility can you handle before you kind of go a little stir crazy and maybe want to sell everything? So whether you're retiree, you're 80, or you're not retired and you're 20, all you're really looking at is what can you handle emotionally in your portfolio. Never invest in anything that can go to zero. So don't buy crazy investments like Bitcoin or futures or speculation investments. Buy a quality portfolio that's diversified. Will the portfolio do some of this over time? Yes. If you're trying to grow your money, you want more growth, but you can still handle some volatility. If you don't like volatility, you have to dummy down the risk of that portfolio. You'll make a lot less money, but ultimately you'll be happy emotionally. Dean in Naples, Florida. I bought 2 equity index annuities 5 years ago, have made nothing. Still have a 6-year surrender penalty. I feel like I was misled and want your opinion on what to do. Dean, we get literally hundreds and hundreds of questions and calls about equity index annuities every year into my office or on my TV radio show. All from people like you that are disgruntled because they were sold or misled when they bought one of these annuities. The bottom line, people that sell annuities are selling these under what's called suitability. They don't legally work for you. They work for the insurance company. They sell the product. Annuities really are just garbage investments that should never be in your portfolio. You've got 2 options. You can keep the annuities till you get to the end of surrender in 6 years. Or option 2, say, you know what, I've had enough. Take the surrender penalty, move on to greener pastures. If you haven't made any money or the returns are lousy the last 5 years when the markets were good, do you think they're going to be any better the next 6 years? Probably not. Equity index annuities are designed to return on average 1 to 1.5% returns. That's what our calculation is a year if you hold them for 10 years. That is garbage returns. You can make a lot more in a CD and have liquidity. But why do people sell annuities? Because it's a great place for them to make a lot of commissions. Avoid annuities at all costs if you care about your money and your net worth. Folks, I love the questions. We're just about out of time. As always, go to ReznyWealth.com. Click on our special reports tab. I know we're getting a lot of calls and questions. The 3 biggest risks you must avoid now for 2024 is a must read. If you have $1 million portfolio and greater, if you're questioning the advice you're getting, if you are at all concerned about the economy, the dollar, the imminent collapse overseas, it's a must-read report so you can basically get the education you need in order to make sound decisions. If you're unhappy with the advice you're getting, go to ReznyWealth.com. Click on that consultation tab. Again, if you'd like to talk to us about professionally managing your money because you want real advice and real money management, again, go to ReznyWealth.com. We appreciate all your questions and comments. Have yourself a safe and profitable day.